What's up, y'all, and welcome to another episode of Money Matters. My name is Nev. I'm your host. In today's episode, I want to talk about what's going on with the yield curve, what's happening on the larger economic markets, and for us to take a look at really how does this impact you and I. Now, one thing you know is that only a week ago, the Fed already increased the interest rate by 25 basis points or 0.25%. You've likely heard that, and that's something that they had to do in order to follow up with what they said, which is, hey, they want to do whatever they can to taper the inflation. The problem is inflation is well over 7%, 7.5 last time we checked, and climbing, and now 25 basis points doesn't do much of anything. If you actually wanted to impact it, it would have to be well above 8%, which is ridiculous, and it would absolutely crash the economy. Now, they went with 25 basis points, and we're already seeing the wheels starting to shake and the nut bolts starting to come off. And that comes with the yield curve. So right over here, I have a yield curve. And right now, as of March 25th, 2022, it is considered flat, but we are starting to see some inversions. For example, the 20-year debt or 20-year loan is cheap or more expensive than the 30. We're seeing that the 7 is more expensive than the 10, as is the 5 is more expensive than 10. And those things don't quite make sense. Now, here is what Fed can actually do. They can shift this overnight rate only, and that's the reason why we're seeing it slightly up, but that's not, they don't have impact on anything else. And of course, it's not doing much of anything other than creating and showing the cracks. Typically, when we start seeing these inversions in the yield curve, it signals that we are having problems ahead. It's sort of like looking at the sky, seeing those dark clouds, you can feel the air shifting, go, yeah, the weather is changing. This is kind of what this is signaling. The weather is changing, and you've likely heard from other folks as well that there is a very real danger of us entering the very next recession. Every single time that the yield curve has inverted, we have hit a major recession, and it was typically at the height of everything where everybody thought everything is going to be perfectly great. But that's not really so. So one of the things I wanted to share with you is the impact that this is having for you, and of course for all of us to be a bit smarter and a bit more careful with our money. Now, speaking of different things that one can do, I know a lot of people have been talking about gold. So let's take a look at gold chart and see what's going on here. As you can see, this is gold in the last 22 years, and it has this beautiful cup and handle pattern, which is very, very bullish. So you will see that it has the sort of the round valley part of it, and then it kind of came down, and it has another smaller round, and that's called cup and handle formation. Cup and handle formation, and that's typically bullish when things are set up to go in that direction. And I believe that right now, with everything that is going on, with the uncertainties, with the war, with the uncertainties about inflation, with the yield curve sort of shifting, I do believe that there's a very good case for gold to perform really, really well. Is it going to do it? I don't know, but we are slowly but surely approaching $2,000, and it's very likely that we will hit it and go above it. So it'll be very interesting to watch and pay attention to. So that's something I wanted to share with you. Now, that's not the only thing I wanted to discuss. I also wanted to go in and take a look at what's going on with the stock market. So let's take a quick look at what's been happening. So NASDAQ is actually down from the January when we opened up markets. So year to date, we're down, and we went from 15,832 to 14,169. That is a very big and deep drop. And of course, I'm sure that you have been experiencing, expecting to see that. Now we're seeing some slight move on up. We'll see if that is going to hold up. But with the yield curve, my fear is that it's going to go up, and then we might see something else break. On the S&P 500, we're seeing that we are currently at 4,543, and in January we were at 4,796. So not as big drop, but definitely a drop nonetheless. And then Dow Jones Industrial at the peak in January 4th was 36,799, and right now we're at 34,861. Again, pretty big drops, and we're talking pretty big losses for many people. And if you've been investing in any of the tech stuff, I mean, you've seen that prices have gone down anywhere between 25% all the way down to like 90 some percent for certain tech stocks, predominantly Chinese and so on. But those are not the only ones. Looking at Bitcoin, we can see that it's been trading in a channel since January, and the channel is slightly on the uptrend, but mostly sideways. And you can see it kind of goes up, it hits the sort of the ceiling, it comes back down, then it goes back up. And so it's been going sideways for a bit, but it does have a slight upward movement. So we're having higher lows, not necessarily higher highs per se, but we're having higher lows. And so that's the interesting piece. We seem to be hitting this 44, maybe up to 45,000, and then it kind of comes back down into the high 30s, low 40s. Eventually, the channel will break one way or the other. And the chart that I'm looking at right now is we're seeing that the 50-day moving average is above a 200 moving average, which is actually quite lovely. But we are also seeing that the starting to sort of level off right around that 44.7, 44.6, and it's starting to potentially turn down. So it'll be interesting to see that. When we switch over to a daily, you can see the same channel, and you can very easily see that it does go up. It hits this sort of top right around 45,000 on daily, and then it starts going back down. And when we look at the daily chart, we are still having a 200-day moving average above 50. So that's something important to understand and note. When it comes to Ethereum, we're seeing that the prices have actually beat over 3,000, and we're seeing some very positive moves there with the burn, and the burn rate is actually slowing down, but that's because a lot of the tokens have slowed down, a lot of the NFT stuff has slowed down. It hasn't died off, please understand that, but it has slowed down and it's not as hot as it was. So we're definitely starting to hit a little bit of a lull, which is helping Ethereum to sort of push these prices. Again, it's trading in a similar way, and in the past, again, they could decouple Bitcoin and Ethereum, but in the past we would see Bitcoin would kind of climb on up, top off, right? And then Ethereum would come on up and top off. And then when Bitcoin kind of goes down, Ethereum typically has a few days to a couple of weeks delay, and then it goes down as well. So we'll see if it's going to decouple at some point, but as of right now, they're very much following each other. Now, we did talk about gold, we did talk about the yield curve, we did talk about the inflation, we talked about the stock market and some of the cryptos. It's time to actually focus on real estate, and mortgage right now is an important concept that we need to talk about. As you know, the yield curve is looking at slowly but surely starting to invert. It's not inverted completely yet. It's considered flat right now, which is sort of like a danger signal. Some of the inversions that we're seeing are definitely warning. The Fed has already shared that they're looking at doing another 50 basis points, so 0.5% increase to the rate in May. And we'll see how that is going to play out. My fear is that it's going to actually completely shatter the yield curve. So we'll be paying attention to that. And recession, as I talked about for months now, is basically going to be coming our way pretty much for sure. I expected that we could see it as early as September, October, and as late as sometimes in 2023. So it's not that far away. And I think it's prudent for us to understand of the different ways that we can protect ourselves. Gold tends to do pretty well. But again, when there's a liquidity crisis and everybody's selling everything, everything goes, everything crashes, and then things start sort of picking up. So cash tends to be the biggest one that actually makes sense, which I understand. There's a lot of problems with the US dollar, but at the moment, and we're looking at liquidity crisis, then having something liquid, and there's nothing more liquid than cash, does make sense. Let's talk mortgage. So mortgage rates, we haven't talked about it in a few weeks. Last time we talked about it, we were just sub 4%. Right now, looking at the chart over here, I can actually see that the mortgage rate is almost coming close to 4.75%. That's almost a percent, an entire percent increase. And we're talking about 30-year fixed, of course. Almost a 1% increase since what, couple of weeks ago that we talked about, which is huge. Now, one of the things to note, and you already might likely You likely might know already this, but when the mortgage rates go up, the affordability of what we can buy starts going down by as much as 10 to 11%. So any 1% increase in the cost of buying a home equals 10 to 11% reduction in what we can afford. So for me, I'm looking at this and saying, are we going to see some softening in real estate prices? Potentially. The supply is still low, the demand is still pretty okay, and we're seeing a bit of a rush of folks looking at these rates and looking at how quickly they're actually going on up and saying, I better get in right now before it goes above 5%, which would not shock me at all. But I think this is something that is very, very dangerous. So between the yield curve and between the cost of borrowing going up, because obviously everything else is going up, we are looking at some very serious problems and potentials that we might be looking into a recession and things might be crashing. The 15 year has also gone up. The 5-year arm is actually also gone up, and it's actually above 3.85%, and it's above a 15-year fixed. Now, when we kind of compare the current mortgage rates by loan types, you can see that right now, 30-year for conforming loans, 30-year fixed rate is 4.62, and it has gone up 0.5% in 1 week, 0.5% in 1 week, and the APR is 4.7%. When we talk about the government loans, they're a little bit easier to sort of swallow, if you would. The 30-year fixed rate for FHA is 3.67, so way better than the 4 point something percent, right? But we did see a 30% increase in 1 week, which is huge. And the APR is not that much more different than conforming. Conforming is 4.7, APR is 4.47, and again, up 30%. Jumbo loans are 4.12% for 30-year fixed, and the APR for the same is 4.18. So when you look at it, the APR actually for jumbo is much more affordable than the conventional and the conforming or the government loans. So this is something that is very interesting. Typically, and not everybody qualifies for all these programs, but typically we're seeing that jumbo, ends up being a bit more expensive. But everything is jumbo these days, it seems like, right? The prices have gone up like crazy, so everything seems jumbo to me. But it's very interesting and very scary to see what's happening with the mortgage rates and why potentially right now may not be the best time to actually go in and purchase a home, and we might see some softening in prices. Again, time will tell what's going to happen. We're starting to hit prime time in real estate because spring is coming in. People that want to list are going to start listing right now. But again, they might look at prices, and part of it is not necessarily what they can make from the house that they are looking to sell, but how much do they have to pay for the house that they want to buy. And then on top of that, you layer the cost of borrowing money, cost of mortgage, and that might actually slow things down in a big way. We'll see how it all plays out. I'll definitely be there and watching this stuff and reporting to you, and hopefully we can have a conversation. Thank you so much for being here. I really appreciate it. And hey, if you're brand new to the whole thing, make sure you subscribe. If you're enjoying this, make sure you like. And I look forward to seeing you in the next episode. Until then, stay forever money blessed. And do remember, you are only one deal away.